90% of people don't fail at investing because they're dumb or unlucky. They fail because the game they think they're playing is not the game that's actually being played. They think it's about prediction. It's really about behavior. They think it's about picking the right stock today. It's really about owning the right process for years. If you've ever felt smart and still lost money, this is for you. The real enemy isn't the market. It's the reflex in your hands when prices move. It's the little story you tell yourself to justify a rushed click. It's the belief that you need to act to be effective. You don't. You need to act correctly, rarely, and with rules. Here's the uncomfortable truth schools never taught. Your portfolio is just a mirror. It reflects your patience, your risk sizing, your attention diet, your tolerance for boredom. Change those, and your results change before your next pick ever does. So why do most investors fail? They buy stories, not businesses. They chase heat, then flee at the first chill. They size positions like gamblers, not owners. They confuse information with signal and movement with progress. They forget taxes, fees, and friction are silent pickpockets. They have no pre-committed plan, so the market writes their script for them. You can fix all of that. Start with identity. Stop thinking of yourself as a trader who must perform every day. See yourself as an owner who must decide well a few times a year. Owners let time work. Owners prefer cash flows to clout. Owners measure in decades. As Charlie Munger put it, the big money is not in the buying or the selling, but in the waiting. Waiting is not laziness. Waiting is a skill. Next, understand the two cycles that run your wealth. There's the market cycle you cannot control. Prices rise and fall, narratives flip, headlines shout. That's weather. Then there's your behavior cycle. Save, allocate, hold, review. That's climate. The first is noisy. The second is cumulative. Most investors spend 90% of their energy on the first and almost none on the second. Flip that ratio and you immediately exit the 90%. Let's make this personal. Imagine two friends, Anika and Joel. Same income, same starting balance. Both invest $500 a month. Joel watches charts like a hawk. He chases sectors after they've already run. He sells when his feed turns red. He pauses contributions because things feel uncertain, then restarts late. He pays extra taxes by flipping too fast. He's busy. He feels heroic. He is constantly resetting compounding. Anika sets an automatic draft. She owns broad, low-fee funds as her core. She adds a few wonderful businesses she understands in sizes that let her sleep. She checks once a month. She increases her contribution by a tiny percent each year. She knows boredom is the cost of greatness. 10 years later, they both contributed $60,000 in cash. Joel has stories. Anika has ownership. Same dollars in, different life out. What changed? Not IQ, not tips. Process. If you want a hard anchor for your mind, keep this sentence visible. I don't need to do more. I need to do less, better, for longer. Now, let's dissect the 7 traps that quietly enroll people into the 90% and the moves that keep you out. Trap 1. Reacting to price. The brain interprets red candles as danger and green candles as safety. Both are illusions. Price is mood. Business is reality. Separate them. Decide that price will only trigger research, not action. Build a 24 to 48 hour cooling period before any sell. If the thesis hasn't changed, you don't either. Trap 2. Mistaking noise for news. A talking head screaming crash is not analysis. A YouTube chart with 12 lines is not evidence. A friend's conviction is not a margin of safety. Choose 3 primary sources that actually move value. Company reports, numbers you can verify, and long-form letters from investors you respect. Schedule 1 hour a week for those. Everything else loses permission to live in your head. Trap 3. Sizing without sleep in mind. If a 30% drawdown on a position would push you to panic, your size is wrong. Right size until you can stay rational. Never let a single idea be big enough to force you into an emotional corner. Trap 4. Calendar myopia. People grade themselves on last week's return. That's like judging a marathon by the first mile. Pick your horizon now. 5 years minimum for equities. If that makes you uncomfortable, you don't need a different stock. You need a different mix. Trap 5. The free tax. Every click costs. Spreads, fees, taxes, and worst of all, the compounding you interrupt. If you want to feel busy, take up a hobby. If you want to get rich, cut friction. Trap 6. Buying what you don't understand. Complexity masquerades as intelligence. It isn't. As Peter Lynch said, know what you own and know why you own it. If you cannot explain a holding to a smart teenager in a few clear sentences, you don't own it. You're renting a story. Trap 7. No pre-commitments. Under stress, humans don't rise to the occasion. They fall to the level of their preparation. If you haven't written your rules in calm, you will improvise in chaos. Chaos is expensive. So what does success look like in practice? Think of your approach as an investing operating system. Simple, sturdy, boring on the surface, powerful underneath. Install Rule 0, survival first. Keep a rock-solid emergency fund so you never become a forced seller. Forced selling is where compounding goes to die. Define your core. For most people, that's a global stock index fund at low cost. It gives you instant diversification across thousands of businesses. If you want bonds for stability, add a sliced match to your risk tolerance and time horizon. Build a satellite. Around that core, you can allocate a smaller percentage to high-quality companies you truly understand. Wonderful businesses with durable advantages, high returns on capital, and management you trust with your own paycheck. Price matters, but quality matters more if you plan to hold through cycles. Label your sandbox. Want to speculate? Fine. Cap it at a small percent and say so out loud. This is my speculation bucket. I expect higher volatility and I can afford to lose it. Honesty prevents expensive self-deception. Write your 2-minute brief. Not 10 pages. 2 minutes. It answers 4 questions for every holding. What is it? Why do I own it? When will I add? Under what conditions will I sell? Tape that brief to the figurative windshield. When temptation hits, you don't invent a plan, you read one. Automate your contributions. If you're paid bi-weekly, invest bi-weekly. If you're paid monthly, invest monthly. Turn should into did with automation. The best timing strategy is not timing, it's time in. Schedule your reviews. 2 dates a year. That's it. 1 mid-year, 1 at year-end. On those days you rebalance to target, harvest losses, or gains tax smart if it makes sense, and update your brief if the facts changed. Outside those dates, your default setting is hold. Protect your attention. Unfollow the adrenaline. Follow builders. Read letters and reports, not thumbnails and doom. Your feed is a training plan for your behavior. Choose wisely. Let's talk numbers for a moment, because clarity helps. A $10,000 lump sum left to compound at 7% annually for 20 years grows to roughly $38,700. Not because you traded masterfully, but because you didn't interrupt compounding. Meanwhile, a $500 monthly contribution at a similar long-term rate can build into the high 5 figures over a decade and 6 figures beyond that. The exact number depends on your returns, but the lesson is stable. Steady ownership beats erratic brilliance. But what about big drops? Won't waiting hurt? Drops are features, not bugs. They're the price of admission for equity-like returns. Decide what you'll do in advance. Create a storm script you can read out loud. Breathe. No sells for 48 hours. Reread the 2-minute brief. Check business results, not price action. If the thesis is intact and the price is down, consider adding within your sizing rules. If the thesis is broken, exit calmly and recycle capital. Fear hates rules. Rules starve fear. Now, a quick story that compresses years of pain into 3 minutes of learning. Maya buys a buzzy stock after it doubles. She rationalizes the entry as momentum. The company issues shares to raise cash. Price falls. She tells herself it's just volatility. The next quarter, revenue misses. Guidance drops. She scans social media for hopium. Diamond hands, they say. Price halves again. She finally sells, scarred, and vows never to invest again. What went wrong? Not volatility, not even the initial mistake. The missing piece was a pre-committed sell rule grounded in facts. If Maya had written, "I will sell if revenue growth breaks for 2 consecutive quarters," or if the company issues equity to fund operations without a clear path to profitability, she would have recycled capital early and lived to fight another day. Rules don't eliminate mistakes. They cap their cost. Let's flip it. Ben buys an unsexy dividend grower at a fair price. The internet yawns. He reinvests dividends. He ignores a dozen end-of-the-world headlines. He trims a little when the position grows too large for his comfort, then lets the rest run. A decade later, his total return looks like genius. It wasn't. It was patience plus position sizing plus a refusal to believe that excitement equals opportunity. If you need a mental model to keep you honest, use these 3 lenses before any buy. Quality. Does this business consistently turn $1 of capital into more than $1 of profit? What defends that engine? Durability. Can it keep doing that through cycles? Are customers sticky? Are competitors locked out by costs, networks, or switching pain? Price. Am I paying a fair price for what I'm getting? Not perfect. Fair. A wonderful business at a fair price beats a fair business at a wonderful price if you plan to hold. And don't forget the Graham compass. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Your job isn't to win a popularity contest. Your job is to own what will weigh more over time. A few practical edges separate the 10% from everyone else. They separate accounts for purpose. Long-term investments live in a place that's hard to rate. Short-term spending lives elsewhere. Out of sight is out of temptation. They write if slash then rules. If a position drops 20% and my thesis is intact, then I add 1 unit. If the thesis breaks, then I sell at the next open and move on. If my allocation drifts more than 5 points off target, then I rebalance on my next review date. No debate, just execution. They track process metrics, not just performance. Did I follow my sizing rule? Did I stick to my review cadence? Did I only buy what I can explain? Process control is upstream of returns. They use checklists. Before buying, circle of competence, balance sheet, moat, incentives, valuation. Before selling, thesis broken, better opportunity with similar risk, portfolio balance. When emotions run hot, checklists keep your brain attached. They build slack into life. A little extra cash, a little less fixed cost. Skills that raise income. Why? Because money outside the market protects the money inside the market. Desperation makes terrible portfolio managers. They choose their peer group. If your friends treat investing like a casino, your behavior will drift toward the tables. Surround yourself with builders who talk in cash flows and time horizons, not tickers and drama. Finally, they forgive themselves fast. You will buy too early, sell too late, miss a winner, hold a loser. Welcome to the human race. The difference between amateurs and pros isn't error count. It's error handling. Reflect. Record the lesson. Adjust the rule. Move on. Let's lock this in with a short, sharp plan you can implement today. Write your 2-minute investing brief. For your core fund and for each satellite holding. What, why add, sell? Keep it plain. Set your automation. Pick a day. Money moves that day. No vote required. Choose your review dates and put them on the calendar, mid-year and year-end. Protect them. Define your sizing bands. A default starter size. A maximum size. A rule for adding. A rule for trimming. Size to your sleep. Clean your feed. Mute 3 accounts that fuel FOMO or fear. Follow 3 that teach patiently. Your inputs sculpt your outputs. Build your storm script. print it or pin it. You won't write it well in the middle of a storm. You must borrow calm from your past self. And above all, practice strategic boredom. Let compounding do what compounding does. You don't dig up seeds to see if they're growing. You water them. You weed once in a while. You wait. If you do these simple things, you will already be doing what most won't. You'll stop paying the hurry tax. You'll stop donating returns to fees, friction, and flinches. You'll graduate from the 90% without heroics. Remember the two quotes that keep you honest. Munger's reminder to wait. Lynch's demand to understand. The big money is not in the buying or the selling, but in the waiting. Know what you own and know why you own it. Put those on a sticky note next to your screen. Read them on quiet days so you remember them on loud days. Your action step for the next 60 seconds is simple. Open a blank note and write. I am an owner, not a tourist. I automate contributions and review twice a year. I only buy what I can explain. I size positions I can sleep with. In storms, I read my brief before I touch the button. I win by staying in the game long enough for the weighing machine to weigh. If this shifted how you think about the game and gave you a concrete way to avoid the mistakes that sink most investors, hit subscribe. Join the group that plays long games with long-term people, that builds quietly, that lets time do the heaviest lifting. The market will keep voting tomorrow. Let it. You're building something the weighing machine will reward.